Hello everyone. Over the next few minutes, I will quickly give you a snapshot as to what actually happened in the bond markets in the financial year 2019 and of course what lies ahead of us in the financial year 2020. To start with, FY 2019 was characterized by extreme volatility, specifically in the second half of 2019 financial year, which was further precipitated by the IL&FS led credit crisis, where we saw a lot of liquidity dry up. So it was a roller coaster of emotions, sentiments, bond yields. The good news is that the 10-year benchmark bond yield closed broadly flattish for the entire year. If you compare it on a stock basis, which is the 2028 bond, which started off at about 7.35 odd beginning of the year, April 2018, closed at about 14-15 basis points higher at about 7.49. But on an index basis, the 10-year benchmark index, because the new 10-year bond got announced of 2029 maturity, that index broadly closed flattish. Across fixed income strategies ranging from overnight liquid funds to gilt and dynamic and long duration funds, FY 2019 had a positive innings, which with each of these categories closing in the positive. One thing specifically to highlight for this financial year was that the credit spreads widened. The gap or the spread between the AAA bond and the sovereign bond, and more specifically the spread between the non-AAA and the AAA widened, and how. And as we speak, the spreads continue to be at elevated levels, though the month of March definitely saw a little bit of respite. Another characteristic of FY 2019 was that YTD, which is the Jan calendar year that starts till date, which is March 2019, we have seen hugely voracious appetite of foreign investors returning back to corporate bonds. So on a combined basis, the month of March, both for equities and fixed income, ended hugely in the positive, and of course year to date the number continues to be positive. So I think those sentiments which were mixed started off on a positive note, getting mixed, and paranoia towards the middle of September ended visibly in the positive. The dollar rupee also depreciated just about 6%, staging a huge comeback specifically in the last quarter of FY 2019. While this was a sneak into the past, what lies for us in the future? For starters, in the first week of April itself, we have the Monetary Policy Committee decision, where there is as of now a consensus view that there could be a 25 basis rate cut. The markets are almost pricing in that outcome. Our stance is that even if there were or not to be a rate cut, I think the guiding principles of the monetary policy could be a possible game changer for the bond markets, which right now continues to be in the positive territory. The bond markets have also got the announcement of the FY 2020 borrowing calendar, which is of sovereign bonds. It seems to be visibly front loaded, which means almost over 60% of the total borrowing will be completed in the first 6 months of FY 20. What this implies for the markets is that we could see a steepening of the yield curve, which means the short and the middle end or medium end of the bonds remain to be supported, whereas the long end of the bonds may not entice as much interest. Hence, we believe it is the short and middle end of the government bond curve which will continue to entice investors, both domestic as well as offshore. We also have the mother of all elections or events, which is the general elections, which is slated for May 2019. That also could lead to some palpitations, though not on an immediate basis. With respect to corporate bonds, we believe that the current spreads are at fairly elevated levels, and barring any major credit event, we believe that these spreads could stabilize at the current levels or maybe start receding marginally as the sovereign bond yield curve starts getting pricier. What should be the strategies in such a market scenario that investors should focus upon? While we have been reiterating for quite some time that it is time to extend duration on your fixed income portfolios, meaning to say, if you have been into liquid strategies, it's time to graduate to ultra short term. Likewise, from ultra short term to low duration, short term, etc. We believe that the short to middle end of the yield curve offers immense risk adjusted value in favor of the investors. So if you have a time horizon of 6 to 12 months, strategies like low duration, or if you have north of 12 to 36 month investment horizon, combination of short term strategies, medium term strategies, and PSU bond kind of strategies would be the way to ride this out. We believe that strategies like fixed maturity plans in an interest rate scenario which is gradually coming down may not be the best prudent strategy at this point in time. I think it is worth taking some open-ended duration risk onto your portfolio, of course keeping in mind that there will be interest rate fluctuations and one needs to ride it out over a longer period of time. With liquidity coming back into focus this year, will be critical to see how much of open market bond purchases will the Reserve Bank of India announce. There has been a dollar-rupee swap window which got fructified in March 2019, which we believe should take care of the immediate liquidity requirements. And of course, going into the next few months, it is critical for the bond markets to ensure that there is reasonably good liquidity, if not surplus liquidity. On that note, we believe that it's prudent that investors position themselves across the yield curve based on one's investment tenure to be able to fully ride through the bond market and its movements in the coming weeks. Happy financial year 2020 and happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.